As of today, Sunday, June 21st, 2026, the stock market is officially closed for the weekend. The latest closing stock price for Ondas Inc., trading under the ticker symbol ONDS on the NASDAQ exchange, is exactly $9.27 per share, recorded at the final bell of the last active trading session on Thursday, June 18th, 2026, since the markets remained closed on Friday in observance of the federal holiday. This level represents a modest upward consolidation of roughly 1.6% over the past 30 days, though it sits below the rapid spikes seen earlier in the month when the stock tested the $13 range. While the headline price action suggests a quiet period of consolidation, the immediate development that completely upends normal market expectations is the staggering volume of new contract awards and aggressive cross-border software acquisitions that management has quietly finalized over the last several weeks. Most casual market observers looking at simple stock screens see a volatile mid-cap technology stock recovering from historical lows, but the deeper reality is that the company has secured more than $110 million in new bookings for the current quarter alone, while simultaneously absorbing premier defense and enterprise analytics platforms. This aggressive operational expansion has forced a massive disconnect between how the stock is viewed by shorter-term retail traders and how it is being positioned by institutional asset managers who recognize a fundamental shift in the company's underlying revenue quality. The common ground shared by most market participants is the belief that micro-cap and mid-cap technology providers are inherently fragile enterprises that depend on constant share dilution to survive, a narrative that frequently drives short interest during broader market pullbacks. When people look for investment help or evaluate general enterprise trends on popular investing sites, the standard playbook dictates avoiding firms with historically negative cash flows from operations. The contrarian reality challenging this consensus is that the firm has completely reworked its operational backbone, parlaying its hardware capabilities into a software-first data ecosystem. While mainstream attention remains locked on the standard megacap choices like Apple stock or the daily trading volumes of Nvidia stock, this specific enterprise has been quietly collecting long-term sovereign contracts that guarantee a highly predictable recurring cash stream for the next several years, completely invalidating the old thesis that this is merely a speculative trading vehicle. Analyzing the intense recent stock movements reveals a fascinating tug-of-war between speculative retail momentum and steady institutional accumulation. Throughout the spring of this year, the asset experienced massive daily swings, climbing from the $7 level in late April to a multi-month high of $13.58 in early June, driven by robust quarterly earnings numbers. This massive upward run triggered an automated technical cooldown as the 10-day relative strength indicator moved sharply out of overbought territory, prompting a healthy 30% retracement to the current $9.27 mark. During this downward drift, trading volumes remained remarkably high, with single-day volumes occasionally breaching 37 million shares, a clear sign of high liquidity and heavy hands swapping ownership. This sort of volatile trading behavior is exactly what draws short-term capital on popular platforms like the Robinhood app or through standard online investment accounts, where retail participants look for high beta instruments to outperform flat market conditions. However, looking past the short-term noise on a standard individual brokerage account, the broader institutional activity paints a far more deliberate picture. Large-scale wealth managers utilizing systems like Schwab Intelligent Portfolios or managing active growth portfolios through platforms like Interactive Brokers Trading have been closely watching the company's structural shift. For anyone engaging in self-investing or managing their retirement capital via Fidelity IRAs, understanding the macroeconomic pressures pushing the sector forward is absolutely essential. Global defense budgets are experiencing unprecedented upward revisions, and critical infrastructure operators face tightening regulatory mandates regarding automated monitoring and security. As a result, the demand for proprietary, highly secure communication networks and automated aerial observation has skyrocketed, insulating this business from the typical inflationary or consumer-centric pressures that trouble standard tech equities. The primary catalyst driving the most recent asset repricing is the company's blockbuster announcement that it has signed a definitive agreement to acquire Cyberhawk for approximately $125 million. To understand why this development completely outpaces general market expectations, one must analyze the deal structure and the immediate financial metrics it introduces to the parent entity. 95% of this transaction is funded via cash, with the leadership team of the acquired company showing immense structural confidence by rolling $5 million directly into Ondas stock under a strict one-year lockup provision. This enterprise brings with it over 300 top-tier enterprise clients across 40 countries, including global industrial giants like Shell and Qatar Energy, along with more than 232 terabytes of highly proprietary infrastructure data. Financially, it is projected to contribute over $45 million in revenue for the fiscal period ending in early 2027, boasting a 95% recurring revenue model and a massive $95 million standalone backlog. This major corporate transaction comes right on the heels of another strategic acquisition finalized in May, where the company absorbed Omnisys to integrate its battle-proven resource optimization software. By layering these high-margin software platforms over their existing hardware base, the underlying economics of the business are being radically rewritten. Instead of relying on lumpy, single-purchase hardware deployments that frustrate analysts trying to model future quarters, the company is successfully transitioning into a premier provider of high-margin enterprise software as a service. This explains why during their first quarter earnings call in mid-May, management took the bold step of raising their full-year revenue guidance to an unprecedented $390 million, supported by a pro forma corporate backlog that now sits comfortably above $457 million. To properly contextualize these figures, it helps to step back and look at what the business actually does under its core operational umbrella. The firm operates through two primary divisions, a specialized wireless technology unit and an autonomous systems branch. The network division focuses on providing high-security, private wide-area data networks for critical infrastructure industries like major rail networks, defense agencies, and energy utilities. These proprietary data links are vital for mission-critical operations where standard commercial cellular networks are completely inadequate due to security risks or coverage gaps. On the other side of the house, the autonomous systems division designs and deploys fully automated drone-in-a-box solutions and advanced high-altitude balloon systems used for long-range maritime domain awareness, counter-narcotics missions, and border security operations. This dual-use commercial and defense architecture creates an incredibly resilient economic moat. When industrial spending slows down, government defense procurement typically steps in to fill the gap, and vice versa. Historically, the firm operated as an early-stage research and development shop, burning through cash reserves to perfect its core wireless protocols and autonomous aviation platforms. This early phase resulted in years of uninspiring financial reports and heavy stock dilution, which is why older screening tools used on conventional investing sites still tag the company with a high-risk profile. But looking at past performance through a rearview mirror misses the entire structural inflection point occurring right now. The reality of their current financial position is defined by multi-million-dollar initial orders, such as their recent $10 million allocation for a border demining program, which represents just the first phase of an extensive $50 million defense award. As we look toward the future, the primary investment thesis for this business will be defined by how cleanly reality matches up against these massive new expectations. In the most optimistic scenario, the seamless integration of these software platforms will allow the combined entity to rapidly expand its gross margins from historical lows into the projected 25% range by the end of the decade. Under this scenario, the massive backlog transforms into high-velocity cash flow, forcing short sellers to completely cover their positions and potentially driving the equity back toward its prior multi-year highs. Please comment below how many shares of Ondas Inc. you currently hold in your portfolio, or tell me if you prefer sticking to larger, less volatile tech companies for your long-term capital allocation. Conversely, the downside risks cannot be ignored by anyone practicing careful online investing. Executing multiple cross-border corporate integrations simultaneously introduces massive execution risks, and any delay in regulatory approvals during the final quarters of the year could stall their financial guidance. Furthermore, because a significant portion of their backlog is tied up in international defense programs, shifts in geopolitical alignments or foreign budgetary appropriations could cause unexpected contract friction. If the company fails to hit its ambitious $390 million revenue target, the market will likely punish the stock severely, sending it back to test key technical support levels in the $6 to $7 range. Investors executing trades through a standard Fidelity brokerage account or Interactive Brokers platform must carefully weigh these fluid operational risks against the massive upside potential of their current contract momentum. When you look at this entire situation through the lens of market psychology, the absolute core of the story is the profound tension between past expectations and the current corporate reality. The general market narrative has long pigeonholed this asset as a speculative, cash-burning engineering project that belongs on the fringes of an individual brokerage account. The emerging reality, however, points to a rapidly scaling critical infrastructure powerhouse that is successfully securing massive defense prime contractor status and locking in predictable, long-term recurring revenue streams. The technical pullback to $9.27 provides a fascinating setup for observers of this market segment. Whether this transformation results in a permanent structural re-rating or serves as a cautionary tale of overextended corporate ambition will depend entirely on management's ability to execute their software integration strategy over the coming fiscal periods. Ultimately, it is this precise gap between outdated historical perceptions and the fast-moving operational ground reality that creates the most compelling opportunities in the modern financial markets.